In the previous session, we discussed four important external sources of finance. Today, we shall continue with the same topic and discuss the other important external sources of finance. In the last session, we discussed equity shares, preference shares, debentures, and loan from banks as the major external sources of finance. Let us continue with the external sources. The next important external source of finance after loan from banks is loan from financial institutions. A financial institution is a company engaged in the business of dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. There are various financial institutions available for the firm as the external source of finance. The list is very long. Let us see few of these financial institutions. Industrial Finance Corporation of India, which in short we call it as IFCI. The next, State Financial Corporations, SFCs. Industrial Development Bank of India, IDBI. National Industrial Development Corporation, NIDC. Industrial Credit and Investment Corporation of India, ICICI. Life Insurance Corporation of India, LIC. Unit Trust of India, UTI. Industrial Reconstruction Bank of India, IRBI. International Bank for Reconstruction and Development, IBRD. International Finance Corporation, IFC. And Asian Bank Development, ABD. Like this, there are various institutions which cater to the various needs of the firms. These institutions provide short-term, medium-term and long-term financial capital for the firms. The companies or the firms have to consider their own situation, their need and their future plans before opting any of these financial institutions. Now coming to the next external source, that is venture capital. Venture capital is basically equity finance in new companies. It concentrates on new emerging companies rather than existing ones. Venture capital refers to financing of new high risky ventures promoted by qualified entrepreneurs who lack experience and funds to give shape to ideas. Venture capitalists make investment to purchase equity or debt securities from inexperienced entrepreneurs who undertake highly risky ventures with the potential of success. Apart from providing funds, the investor also provides support in the form of sales strategy, business networking, and management expertise, enabling the growth of the entrepreneur. Coming to the next external source, bank overdraft. An overdraft facility allows customers to use or withdraw money from their account up to the approved limit. It works like an approved loan where the interest is charged only on the utilized amount. An overdraft facility helps individuals and self employed businessmen to resolve short term cash flow issues. Customers are allowed to withdraw in excess of credit balance standing in their current account. A fixed limit is granted to the borrower within which the borrower is allowed to overdraw his account. Interest is charged on daily basis. The eligibility for the overdraft limit is decided by the bank based on the customer's repayment history and account balance. The companies or the firms can resort to bank overdraft for their short-term financial needs. Coming to the next external source, leasing. A lease is a contractual arrangement calling for the lessee, that is the user, to pay the lessor, he is the owner, for use of an asset. I repeat, a lease is a contractual arrangement calling for the lessee to pay the lessor for use of an asset. Property, buildings, and vehicles are common assets that are leased. Industrial or business equipment is also leased. Broadly put, a lease agreement is a contract between two parties, the lessor and the lessee. The lessor is the legal owner of the asset, while the lessee obtains the right to use the asset in return for regular rental payments. The lessee also agrees to abide by various conditions regarding their use of the property or equipment. Let's take for example, a person leasing a car may agree to the condition that the car will only be used for personal use. There are mainly two types of lease: operating lease and financial lease. Coming to the first one, that is operating lease. In an operating lease, the lessee uses the asset for a specific period. The lessor bears the risk of obsolescence and incidental risks. There is an option to either party to terminate the lease after giving notice. In this type of leasing, lessor bears all the expenses. Lessor will not be able to realize the full cost of the asset, and specialized services are provided by the lessor. This kind of lease is preferred where the equipment is likely to suffer obsolescence. Coming to the second type of lease, that is financial lease. Financial leasing is a contract involving payment over a longer period. It is a long-term lease and the lessee will be paying much more than the cost of the property or equipment to the lessor in the form of lease charges. It is irrevocable. In this type of leasing, the lessee has to bear all costs and the lessor does not render any other service. The next important and the last external source which we are going to discuss is factoring. Factoring, or the word factor, has been derived from the Latin word facere, which means to make or to do. Factoring is a method of financing whereby a company sells its trade debts at a discount to a financial institution called a factor. It is defined as a service of financial nature involving the conversion of credit bills into cash. Factoring is a continuous arrangement between a financial institution, that is who is called as factor, and a company called as client, which sells goods and services to trade customers on credit. As per this arrangement, the factor purchases the client's trade debts, including accounts receivables, either with or without recourse to the client. With recourse option says that in case the debt, the account receivables is not received, then the loss can be recovered by the factor from the client. Without recourse option states that in case of default by the debtors, the factor cannot look forward to the client for the recovery. The client is immediately paid 80% of the invoice. When the customers repay their dues, the factor will make the remaining 20% payment. Thus, a factor is an agent who collects the dues of his client for a certain fee. Looking at all the various external sources, the firm has to consider the pros and cons of each source of finance and then decide which source is to be opted. In the last session and in this session, we discussed the various external sources of finance. I would like to recall that the sources of finance was classified into two: internal source of finance and external source of finance. Under internal source of finance, we had three sources, that is retained earnings, sale of fixed assets, and better management of working capital. In the external finance, we discussed equity shares, preference shares, debentures, loan from banks, loans from financial institutions, venture capital, bank overdraft, leasing, and factoring. In the next session, we will discuss about the investment decisions under uncertainties. For further reference, these books can be looked at. Thank you.